Before I start this episode of our Grow It campaign, I want to say a quick thank you to the episode sponsors. They are Wealthify and Fidelity. I'm going to say a quick bit about each proposition, so make sure you listen to them, because later in the series, when I talk about the different propositions out there, they'll be useful to refer back to. Do remember that with investing, your capital is at risk, so the value of your investments can go down as well as up, which means you may get back less than you invest. That is relevant to each of the propositions I'm going to talk about. First up, Wealthify is a multi-award winning online and app-based investment service founded in 2016 and backed by Aviva, with a simple mission to make investing accessible to everyone. You can invest from as little as £1, £50 for pensions. Wealthify has a simple yet competitive annual management fee. Investment costs also apply, and offers a number of investment products, including a stocks and shares ISA, a general investment account, a personal pension, and a junior ISA. Within each of those, you can invest in a range of managed portfolios with varying risk profiles and even ethical portfolios. For more information about Wealthify, please visit wealthify.com/MTTM. Now, Wealthify does not offer advice. If you're not sure whether investing is right for you, then please speak to a financial advisor. Wealthify is authorised and regulated by the Financial Conduct Authority. Finally, I'd like to say thank you to our Grow It series sponsor, Fidelity International. Whether you're just starting out or an experienced investor, Fidelity offers a wide range of investment options with plenty of information, tools, and guidance to help you make more of your money and achieve your financial goals. For more information about Fidelity, please visit fidelity.co.uk/money to the masses. In this video series, I provide an introduction to investing. And by this point in the series, you will now understand why you should think about investing and also the things to think about before you start investing. Now, in this video, I'll cover understanding investment risk and return, as well as the relationship between them both. And I will also touch upon how your investments may be taxed. Now, investing your money can be a great way to grow your wealth over time, but it does come with risks. Investment risk refers to the possibility that your investment doesn't perform as you'd expect or like. Now, this includes the likelihood that you lose some or all of your money. And when we talk about investment return, this is the difference between what you get back and the amount of money that you originally put in. First of all, let's explore investment risk. There are different types of investment risk, which include market risk, credit risk, liquidity risk, currency risk, inflation risk, and interest rate risk. And different assets that you invest in will be exposed to these types of risk to varying degrees. Now, the greater the level of investment risk, the greater the potential return that you can achieve. But there is also the greater chance that things may go wrong and you lose money. The relationship between risk and return is important, but because investment returns are not guaranteed, it is difficult to quantify. Now, while past performance is not a guide of future returns, studying risk and returns of different assets over time can provide some insight. The Barclays Equity Gilt Study is an annual report that analyses long-term investment returns in the UK. It looks at the performance of UK equities and gilts, as well as cash, and when I say gilts, that means government bonds, over different time periods going back as far as 1899. Now, if you look at the report from 2021, equities have historically offered higher returns than gilts, but they also come with higher risk. Equities have achieved an average annual return of 5.5% above inflation. Now, remember that inflation in the UK is targeted, as measured by CPI, to be 2% a year, while gilts have averaged an annual return of 1.3% above inflation. Now, equities are more volatile than bonds, meaning that their returns can vary more widely from year to year. In fact, equities have experienced negative returns in 22% of the years analysed in that study, compared to only 6% for gilts. So one key takeaway is that the stock market has seen large swings in returns over short periods, but long-term returns have been positive. So, what does this mean for investors? It means that if you're willing to take on more risk, you may be able to achieve higher returns over the long term. However, you also need to be prepared for the possibility of losing money in the short term. If you're more risk averse, you may want to consider investing in lower risk assets such as bonds, even though they typically offer lower returns. But it doesn't have to be an either or choice. By investing in a range of assets, should any underperform for a period of time, then the performance from the other parts of your investment portfolio should hopefully mitigate these losses and help smooth out the returns over time. This is known as diversification. It is important to assess your own attitude to risk before you start investing as well. That way you can make sure that you are making the right investment choices for you. So before you go any further, it's important to understand your risk profile. And one way to do this is to ask yourself a series of questions. So how would you feel if your investments lost value? Would you be able to handle the loss without panicking, or would it keep you up at night? What do you need the money for and when? And can you afford to lose all of your money? A more technical way to assess your attitude to risk is to complete a risk assessment questionnaire, which will ask you questions about your financial situation, investment goals, and risk tolerance to help determine an appropriate investment strategy. Now, there are risk profiling questionnaires online which you can use for a one-off fee, and I link to one such service in the notes of this video. It's very similar to the type of questionnaire many financial advisors use to assess your attitude to risk before they make an investment recommendation. Another alternative is to go through the risk profiling journey offered by many of the so-called robo-advice propositions or online investment services, which I will speak about in the later videos. But while you may have to register your details, there is no obligation to actually invest through them, and you can just use their risk profiling journey to find out more information about your own risk profile. Again, I've shared a link to our best buy table of these propositions, which you can click through to, and you can then go and look at reviews of each of them. Now, I want to briefly move on to taxation. Any profits or income produced by your investments will be liable to taxation. Now, in the notes of this video, I've put a link to a full explanation of how investments are taxed. But broadly, if you receive income from your investments, such as dividends from shares or rental income from property, you may have to pay income tax on that income. Now, the rate of income tax you pay will depend on your total income, including your salary and any other sources of income. The current rates are 20%, 40%, and 45% that are applied depending on how much you earn. However, there is an annual personal income tax allowance, which is currently £12,570, but this does tend to increase over time, but the government will announce that. You only pay income tax on earnings which are above this threshold. Now, when you come to sell an investment that has increased in value, such as shares or rental property, you may be liable to pay capital gains tax, which is known as CGT, on the profit. The CGT rate is 10% for basic rate taxpayers and 20% for higher and additional income tax payers. Now, the rates are different for gains made on property, but I'm not going to go into that in this video. However, there is an annual tax-free allowance for CGT that's currently £12,300, and it's at the time of making this video, but it will drop to £6,000 in April 2023. As long as your gains do not exceed this allowance in a tax year, you won't have to pay any capital gains tax. Importantly, I'm not referring to gains that are made on paper, but actual gains made when you've sold the investment. But the great thing about investing is that it is possible to mitigate most taxation that's applied to any income or capital gains. And you can do this by investing via products such as an ISA or a pension. Now, not only can you legitimately avoid paying tax on what comes out of your investments, but your money can grow tax-free while you are invested. And in the case of a pension, you can even receive tax relief, essentially tax back, when you pay into it. And I will discuss ISAs and pensions later in this series. If you understand investment risk and return as well as your own risk profile, you can make sure your investment decisions are suitable for you. By being mindful of how your investments are taxed, you can keep most of, or if not all, of your income and profits that are generated and protect them from taxation. And you can even get a boost from HMRC too.